Everybody focuses on lot size whilst ignoring the real killers, leverage and margin. What actually separates a profitable trader from someone who constantly blows their account is not a secret indicator or any 100% win rate strategy. It all comes down to three boring, most ignored, but absolutely critical pillars: position sizing, risk management, and trading psychology. Welcome to episode 6 of our series. This episode is not about strategies or making money. It is about not losing money. Because if you focus on not losing money, you put yourself in a best position to win. Most trading educated skips these boring basics like leverage, pips, margin, and lot sizing. Due to this, most beginners skips and jump straight to looking for strategies. But here is the hard truth. No strategy can save you if you don't understand these basics. Today I'm going to break down these basics in a way that actually makes sense and show you how they affect your accounts and trades. So let's get into it. Before we can understand position sizing and risk management, we need to understand these basics: pips, lots, leverage, and margin. Let's look at them one after the other. Pips is an abbreviation of percentage in points. It is a fundamental concept used to measure price movement. We use it to calculate our profits and setting a precise and accurate stop loss. For most currency pairs like the EURUSD, a pip is the 4th decimal place number. For example, if price goes from 1.1850 to 1.1851, that is 1 pip. For JPY pairs like the USD JPY or Euro JPY, a pip is the 2nd decimal place number. For example, if the price goes from 150.01 to 150.02, that is 1 pip movement. There is also a smaller unit called the Pipette. This is a fractional pip. It is 1/10 of a pip, and it is usually written as the 5th decimal place number or as a superscript on most trading platforms. Commodities like gold and BTC also moves in 2 decimal increments. For example, if the price of gold goes from 4,039.10 to 4,039.11, that is 1 pip movement. And the pip is the 2nd decimal place. But unlike normal currency pairs, these assets are extremely volatile, and a single tick can shoot from 20 to 50 pips. US oil is quoted with 3 decimals on most brokers, and the pip is the 3rd decimal place. But how much money is 1 pip? This entirely depends on your lot size. You don't trade single dollars in Forex. They are traded in blocks called lots. The lot size determines if 1 pip is $1, $10, or $100. The standard lot size in the Forex market is 100,000 units of a currency. Meaning to trade Euro US dollar at a standard lot, you will need 100,000 euros. And if you buy Euro USD at a rate of 1.1850 and the price later moves to 1.1851, that is 1 pip movement. But how much money is that? Let's find out. The exchange rate shows that 1 euro is equals to 1.1850 US dollars. But you bought 100,000 units. Therefore, 100,000 euros will be 118,500 US dollars. And now 1 euro is equal to 1.1851. With the current exchange rate, 100,000 euros will be equal to 118,510 US dollars. So if we subtract the initial exchange rate from the current exchange rate, we will get $10. And from this calculation, we can confirm that the value of 1 pip with a standard lot is $10. There are other lot sizes. The mini lot size. This one is 10 times less than the standard lot size. So that is 100,000 units divided by 10. And you will get 10,000 units. And if you apply the same calculation, you'll see that 1 pip of this lot will be $1. There is also a micro lot, which is 100 times less than the standard. That is 100,000 units divided by 100. And you will get 1,000 units. And if you apply the same calculation, 1 pip of this lot will cost 10 cents. And the minimum lot size is the nano lot, which is 1,000 times less than the standard lot. And that is 100,000 units divided by 1,000. And you will get 100 units. And if you apply the same math here, you will see that 1 pip of this lot is 1 cent. Most trading platforms uses this quantity-based lot sizing, but thankfully your trading platform, the Meta 4 and the Meta 5, simplifies this math. It divides each lot sizing by the standard lot size to get a small number. Instead of 10,000 lots, it is simple 1 lot on MT5 for standard lot size, 0.1 for mini lot size, 0.01 for micro lot size, and 0.001 for nano lot size. Not every broker supports this, and it is usually called a cent account. You might be wondering why we are able to trade in the forex market even though most of traders don't even have up to $100,000 in their accounts. This is where margin and leverage comes in. Leverage is your broker letting you control massive position size with a tiny account, and it is expressed in ratio. With 1:100 leverage, you control $100 worth of position with every $1 in your account. Put in $100 and you can command a $10,000 position. Some brokers go as high as 1:1,000 leverage. With that, $1 controls $1,000, and just $100 lets you open a full standard lot. That is 100,000 US dollars. But there is something important you need to understand. Leverage does not change your lot size or your pip value. It simply increases your buying power. 1 pip on 1 lot size position is always $10, no matter what leverage you use. Let me break it down with a simple example. Imagine 2 traders, each have $100 accounts. Trader 1 is using 1:1,000 leverage, meaning he has a trading power of $10,000, enough to open 1 standard lot. Trader B has 1:100 leverage. That means he has a trading power of $10,000. So their maximum safe position is 1 mini lot size. But here is the danger. If trader A opens 1 lot size, every pip is $10. That means he only survived 10 pips against him before his entire account is gone. The maximum lot size for trader B is 0.1 lots, and every pip is $1. That gives him a survival range of 100 pips. This example proves one thing. Leverage gives you power, but your lot size decides your survival. But your broker is not just using that money to open trades for you for free. To open a position, the broker locks some amount from your deposited money, and this deposit is called a margin. Margin is a very confusing thing to most beginners. Let's break it down with real life scenario so that you get it well. You walk into a car rental shop and rent a car. That actual price may be $20,000, but you don't have to pay the full amount. Instead, they ask for just $200 deposit to let you use the car. The $20,000 car becomes your trade size. The $200 that you have to deposit becomes your margin. and your ability to drive $20,000 car with only $200 is leverage. As long as you drive the car safely, your deposited amount is untouched. But if you damage the car, they take money from that deposited amount to fix the damage. If you continue to damage the car to an extent that the deposited amount can't cover it, the company stops you to prevent you from going into debt and to prevent further damage to their car. And your driving speed becomes your lot size. The safer you drive, the less likely you are to damage the car. And the more aggressive you drive, the higher the chance of damaging the car. If you have $100 account with a leverage of 1:100 and open a trade with 0.01 lots, your broker calculates your margin as the trade size, which is 0.01. That will be 1,000 units. So your margin will be 1,000 divided by your leverage, which is 100. So your broker will lock $10 of your account to open the trade. And if the trade is going against you, your broker will continue to use the remaining of your balance as the margin until your balance is lower than the required margin. And your broker will automatically close you out. And this is called a margin call. That was a lot of math today, but it is necessary. Most beginners and many intermediate traders do not understand these concepts, and that is why they blow their account easily. Everybody focuses on lot size whilst ignoring the real killers, leverage and margin. In the next episode, we will combine everything we have learnt in this episode to master risk to reward calculation and professional risk management plans. Do me a huge favor by liking and subscribing to this channel. Also tell me in the comment section what you think I did right or wrong, or if you have any question to ask. Leave it in the comment section. I'll do my best to reply to them. This is GeniusFX. Learn, trade, and profit.